Good afternoon. Welcome to Options 101. Today we're going to be talking about options and how you can use them to enhance your portfolio, and it just kind of helps buffer some of the issues that a lot of investors face when they have to decide what kind of stock am I going to buy. There are ways that you can actually protect yourself from downside risk, from upswings in the market, and you can grab some portfolio money off of that you can't do if you just buy and trade stocks in a non-options environment. So when you think about options, to me, every day we choose whatever we want. I mean, there's options when we walk outside and we want to get a burger or something like that. We can go to Burger King or we can go to McDonald's. There's all kinds of choices. Like, I don't want a burger. Maybe I want a Taco Bell, or I want Jack in the Box for, their shake or something like that. But you're choosing options every day. And to me, when people go to do investing, a lot of times I hear people say, well, what kind of stock should I buy? Or what kind of equity is the best? Or they want a hot tip or that type of deal. Really, to me, you've got to look for those types of things by using fundamental analysis, but then on the long side, you really need to also think about, well, what are the ways that I can get into this position? Not just have a goal in mind, not just blatantly walk out there and say, hey, I think I'm just going to get whatever's out there at this particular moment in time. I put this little comic in. It was pretty funny to me. I can see myself having this talk with my son, but he's only 2 right now, so I'm sure he would be annoyed at this kind of conversation at this age. But anyway, just a little comic for humor. So again, stock options can add a layer of control to your portfolio. You could sell a put, and we'll go into some of these strategies as we talk later. But there's activities that you can do to help minimize the downside of an entry into a stock. It can make you money whether the stock goes up, down, or it doesn't go anywhere at all. There are ways and strategies to profit from an equity transaction, even if it doesn't go anywhere. Even if the actual underlying, let's say we're talking about McDonald's and it's at $99 a share, it can be at $99 a share at the end of that trade, and you could have made money. So you just have to, there's a whole bunch of ways to do that. If performed properly, it can add a layer of protection to the portfolio. I love this strategy because there is a couple of different strategies that you can use to do this. One is called covered call. This particular strategy allows you to collect a premium on a stock, kind of like a dividend, but you don't necessarily have to sell the stock right away. If it hits that price of what you sold, then it will be called away. But you don't have to. It gives you a level of control that you can actually make a premium similar to a dividend. And if that stock that you chose also pays a dividend, then it's a double win. Okay, so I know all this sounds like pie in the sky, and oh my God, you're just rambling on about all these different strategies, and I don't understand what we're talking about. So we'll make it real simple. We'll boil it down to something that's very easy to understand. So a call option. A call option is, if you have a stock, let's just use McDonald's for example, and let's say it's at $100. You could buy a call option on McDonald's at the $100 strike, and you would pay a certain amount for that, a certain premium, and it has time value and intrinsic value. So basically, you're buying the right to own that stock at a price whatever above the strike that you bought. So the gain potential on that is infinite, but the time is not. All call options have an expiration date. It's kind of like a time to live. So you have to keep that in mind when you're deciding which ones that you're going to buy. But for now, let's just understand that call options are profitable when the stock goes up. A put option is profitable when the stock goes down. So if the stock goes down, you make money on a put option. If it goes up on a call option, you make money. So you can think of it like picking up the phone. You pick up the phone to call, so that's going up. You hang up the phone, it's going down, that's a put. Just a kind of one of those ways to remember which one is up and which one is down, because if you use the wrong strategy, it can go against you pretty quickly. This one has a finite profitability range because a stock can only go to 0. So it can't go, if you had a stock that was at $20, it can only go to 0, so you only have a $20 margin range there, whereas if the stock goes from $20 to $3,000, it could be an infinite return. So here I used a screencast from Monster.com, great website by the way. You can actually open a portfolio with Monster.com for free and get started practicing some of these strategies with their play money. They have a paper trading account that you can start training and learning, and there's also a bunch of great videos on there that you can watch that goes into extreme depth on different types of call strategies, different types of put strategies. So in this example, we're buying one Walmart call. This happens to be the January 8th strike. When I created this slide, or I'm sorry, this is the March strike, which is coming up for expiration now. I actually created this slide presentation for a class that I did about a month ago, so this is a little bit dated information. So you will see here that on this is a call on January 8th, and it would expire in March. So when this was created, it would have given you a couple of months worth of time for that call to actually work. And this is the 60 strike. So if you're going to buy the Walmart 60 strike, it would have to be above $60 for you to profit on that trade. And this actual cost is $1.07 for this call. So all of these are in 100 blocks. You can't buy a call for only 50 shares, for instance. They have to be in 100 stock blocks. So you always take whatever the price is, multiply it by 100, and that will give you your actual call price. So in this case, the call costs us $107. So then what I did is, on Monster.com you can actually do mock examples. It will let you go and calculate what-if strategy scenarios. So if at the end of February 29th in this example, the Walmart had gotten to $66 and I had bought that call option for $107, that call option would be worth $602 by February 29th if it reaches that $66 price target. So you can see that's a 462% gain. Now I don't know about you, but who wouldn't be excited about 500% gain? That's fantastic. Now you understand though that in this scenario Walmart doesn't usually move that fast, so realistically you'd have to target for a more plausible gain on that. So maybe, even if you only doubled your money, you could turn your $107 into $214. So just an FYI. And you can also see on the line graph here, as the time marches on, the call becomes worth less and less money if the stock is not going up. So you have to keep those in mind as well, to try to keep in line with your profit margins and what you're wanting to make out of the trade. I also wanted to put the bad in here as well. So this is what would happen if Walmart stock by February 29th went down to $52 and you had bought that call. In this case, it would have gone to 0, because the farther away that stock is from the price that you bought, which is a 60 call, it reduces the price of that call exponentially. So in this case, you lost all your $107, but you cannot lose more than what you put in. So if you only put $107 in, you cannot lose more than $107. And also, the puts work in the exact same order, but in the reverse order. So stocks versus options. This is kind of a coined phrase on Fast Money Show, but I think it's a great way to understand what the differences are. Why would people choose options over stocks exclusively? They probably wouldn't. For me, I don't use more than about 5% to 10% of my portfolio at a time on actual options, because the volatility is a lot higher, so the price can fluctuate quite a bit. But if you were going to compare, why would use one or the other? It would be, if you buy 100 shares of Walmart, it costs you roughly $5,900, and like I said, these were from a couple of months ago. But if I buy an option to control 100 shares at $60, it would cost me only $107. So if Walmart went to 66 by March, the shares would be at $6,600 for a profit of $700. Or I could have bought the option for the same for only $107, and I would have made a profit of $495. So you can see, not quite as much profit, but your risk outlay capital is not near as high. I mean, you only risked $100 versus almost $6,000. Here I just kind of broke it out. What would have happened to Walmart? The two scenarios that I provided were Walmart goes to 66, Walmart goes to 52. So in those two different scenarios, what would have happened to my profit loss in those two scenarios? So if I had just bought the stock, I'd be down a $600 loss, whereas in the case of the option, I'm only down $107. But understand, that was a timed investment. So the $107 is gone and the option is gone. It expired worthless. So with the stock, you could have time for a recovery if you waited it out, for instance. Maybe you have plenty of time to wait it out. Options have an expiration date. Always remember that, and keep it to a minimum. Only use about 10% of your portfolio to do these types of transactions. They can be they can grow to be 500% gains. It's really not that difficult to do that with an option, but understand that the equity could move against you and it could be gone. Thank you for watching, and if you have any questions, just give me a call.